different view from here. Perfect. So let's just jump right into it then. Ms. Muhammad just gave us a wonderful remark on what family offices are and how they operate, but I would like to ask each and every one of you, what does your respective family office do? What do you guys invest in? Sure, let me start with you.
Sure. So our primary focus is now more liquid and non-market correlated. What we've done, I started our family office in 2011. We've done private equity, venture, we've done real estate, we've done fine musical instruments. But my wheelhouse has always been liquid, and my preference is probably daily liquidity. Right now we have a strategy that has maximum down of 40 to 190 bips in one day, but recoverable within 2 days or a 24-hour trading period, and that only happens max 3 times a month. So that's really what's been capturing my attention, and also hiring engineers and traders who can focus on strategies like that. We've done a lot of ventures, so I funded over 100 crypto projects, and I've seeded and invested in over 100 traders and managers. And we still hold a lot of our crypto positions, but truthfully, I've probably lost a lot more money in luxury real estate than I've lost in crypto. So we're going to maintain our venture positions. I really feel like venture is the backbone of America and probably one of the most beautiful things about our country. That said, the bread and butter is going to be the way trading.
Wonderful, thank you. Neil?
Not to be redundant, I'm going to cover the general items that I said before. On commercial real estate, we focus on portfolios of warehouses, and mainly on the Mid-Atlantic and in the state of Georgia. On life science centers that spread between the outskirts of Boston, San Francisco, San Diego, and the Chapel Hill triangle down in North Carolina. On data centers, I have preferences to be on the northern side of the United States, as data centers require a temperature, and because not only the outside temperature, there is also the temperature generated inside by the equipment. I'm surprised to see people building data centers in the south. I say it's not necessary. I learned the business through investing in the country of Estonia, which is today the capital for the entire European countries on data centers. They do have the right weather, which is always between 68 and 72, from what we learned, but I haven't seen it 72, it's always lower. And they have the grid, they have the backup in case of a blackout, and they do have the skilled labor that can cover the different languages, and also the 24/7. There are concerns when you talk about data centers, but again, that's a conversation that will take 2 days, and already Paul probably looking at me saying enough. So the last thing that I want to say also, that renewable energy is on my radar screen, and especially I am, just like most of you in the investments, I am fascinated by liquid hydrogen and also by lithium. We know that lithium today is shared by 2 nations, and they've been stocking on lithium, and that is creating a problem. But many of the people involved in R&D, they are avoiding now lithium, and they're going even ahead with the liquid hydrogen due to its abundance in the environment, and also the way that it can be stored and it can be transported. On waste management, and I will stop here to be cognizant and equitable with my colleagues. On waste management, we are involved into reprocessing used automobile tires, and to take the technology, it is an American technology, to take it also abroad to our region and to another countries. Thank you very much.
Great. First of all, I want to thank Paul for having us. This is a wonderful opportunity to share all the things that we have that we're working on. So GS Advisors is an organization that started in 2009 to organize my family's business activities. We had an operating company at the time, but started to get some liquidity out of it, and we were becoming increasingly complex. In terms of the activities, it revolves around 2 areas: our investment practice and our philanthropy. Our investment practice focuses primarily on a concentrated portfolio of long-only equities, and to a lesser extent, industrial real estate in the Midwest. And our philanthropic activities surround entrepreneurship, education, and health and wellness. Happy to double click on any of those things.
Well, welcome everybody. Good to be here. My name's Brian Galusha, over managing partner Arivado. It's essentially our public facing of our family office that was emerged ultimately from our real estate activities over the years, going back to the 1970s. Some of our family members and a few of our family friends had 3 different real estate development entities, the land development and building development. The land side really took off over the years, and building development certainly did some pretty meaningful volume as well. Much of that portfolio from the 70s, 80s, 90s still exists yet, more in the northern part of the U.S. About 20 years ago, one of our family friends actually moved down to Atlanta and took us right into the financial downturn or the banking crisis about 15 years ago now. Took advantage of some amazing opportunities. Some of the banks gave us development sites at pennies on the dollar back then, and that resulted in a series of some significant liquidity events in which we've been recycling that capital into a very specific strategy these days, where we own and control over 30 development sites throughout the southeastern Texas, leveraging our domain expertise quite heavily and some other proprietary things that we're doing with budgeting. Outside of real estate, we've complemented some of our interests with another family friend who is a outstanding asset manager in the telecom space that brought us into cell towers over the last 10 plus years or so now in Africa and Latin America. Ultimately, down there as well, especially in Africa, you got to provide a lot of the power generation, and we brought some of that into the U.S. a little bit more recently as well, working on some larger scale solar projects that are providing power for some of the largest telco players here in the U.S. And then over the years, just been in and out of a couple other, old economy business endeavors as well, like in the manufacturing, logistics, and then have a transportation business outside the U.S. as well.
Perfect, thank you guys. Brian, like many investors, is moving out of New York. I'm trying to get this amount of views up. So fortunately, he's still here with us today. Ms. Witter, I want to ask you, your family office can essentially invest in any hedge fund in the world, but why did you guys choose to set up a family office in the first place? What was the intention of doing so?
So my background is, I actually started investment banking when I was in high school. So I was at Lazard Frere for 8 years as an unpaid intern through high school and college. Saw that side of the business, realized it wasn't for me. And when I graduated from University of Pennsylvania, I went to work for Eddie Lamper at ESL. So, and that was fortuitous for us because that was the year we started looking at Apple stock. My father was in the process of unwinding his real estate portfolio in the city and converted into Apple stock for me and my brothers. But I was on the hedge fund side, and I had launched 6 hedge funds and strategies in my 20s, and had really been through the ride with the SEC and dealing what it means to provide compliance and operations when you're managing outside money. And with my family wealth and plus my husband's family wealth, because he is the grandson of Dean Witter, his wealth is based on Oracle. We combined our resources for me to start the family office, primarily because I wanted investment freedom. So when you're managing money for clients, we were benchmarked in certain situations to the Russell, and then you're really locked into certain strategies. To become a family office meant we could be nimble. So one of the first traders that I invested in was short fraudulent Chinese companies. And those returns were in the hundreds, but they're short-lived. That strategy was probably good for us maybe for 8 to 12 months, maybe a few months longer than that. And then, so it's very opportunistic. I found that in a family office structure, I could really do what I love the most, which is find talent, whether it's a trader or crypto or engineering, and finding guys who can really bring forth outsized returns for our family office. And then also within the family office, there's no restriction as far as if you want to do private equity or venture. It's really for a person with city kid ADD, which I have, it's really just so exciting to be able to make money wherever you see opportunity and not be restricted by anything else.
I love that, thank you, Sharon. You and I definitely need to speak at this conference. So, Gil, I have to ask you, today where we are in this industry, you see a lot of hedge fund managers like the great Leon Cooperman, who's a beneficiary of Fordham University, or Mr. Ray Dahlia from Bridgeport Associates, taking their hedge funds and expanding into family offices. I'm curious to see, why do you think that is?
Well, I think the compliance that's needed to run a hedge fund today is very onerous. In fact, the barriers to entry have never been higher. I think also they see that there are, when you manage other people's money, you have constraints, you have rules, you have to stick to your sort of your vision. But they clearly see opportunity far beyond the mandate of their respective funds. And I think the family office is a great way to pursue those opportunities.
I love it. Mr. Belushi, as someone who oversees hundreds of millions in real estate, how does a family office like yourself go about sourcing the best deals and operators? What attributes do you guys look for?
Well, a lot of it is, especially when you do this a long time, you have a lot of folks that call you up, and like I said, we have one of our business development guys in Atlanta. He's he's been around the block quite a long time, and and when you have done quite a bit of development, I mean, certainly people find you. Ultimately, it really comes down to I just said this in Cape Town not too long ago in a keynote, is I talked about the power of hello, and people I think love that, because that's what my great uncle was always about. Just driving around, seeing people working on the side of the road on a job site or whatever, just getting out, saying hello, and finding out what they're doing and uncovering opportunity. And I've kind of taken that to a little bit of the modern world, where I'm constantly in dialogue, engaging with folks, and a lot of times that just opens up networks and opportunities. Like just this past week, I had an old broker contact of mine have a land development group in Florida meet with me, and they're a very, very talented group at finding development sites. We own quite a few in Florida at this point, and we're always put a premium on folks that identify excellent locations that can zone and entitle them. We understand how much work that takes, because we've done that in a different entity for 30 plus a little over 40 years actually. So we value that quite heavily, and this is an opportunity I know that's going to result in us looking at sites. Also, within the family office community, there's another family in Florida, going back there again. They're also in real estate development, but do not have nearly the cash resources that we have, or can scale like we can. So a lot of times, one of their guys who handles business development for them, excellent job at locating, some outstanding development sites. Some of them that are just too big for the family, so he'll bring them to us. So it's just a combination of just being out there, building benches and building networks of really talented people that you trust. That hopefully they're the first or second, phone call, and just continue to build relationships just naturally like this.
It's a lot of networking, I love it.
It certainly is.
Brian knows one of the first times we met, he made a mistake to give me his number, and I could call him. He knows I'm persistent. Camille, do you want to expand on this topic and tell this audience what you look for? Because there's a lot of very talented hedge fund managers, private equity, and see some venture capital as well. What attributes do you look for? And I also want you to talk about a story you told me one time where a 20-year-old investment banker came to you and he wanted to advise you on oil. If you wanted to tell the story, that was fun.
I normally enjoy telling the fund managers in different events on what to do and what not to do. In a recent presentation, we were at the University Club earlier this year, 2022. The audience, they were all emerging managers. And I mean, I'm flattered that they did not leave. You know, normally people after lunch they leave. That day they did not leave. And the organizer, English, she said to me, they are not leaving. They're waiting for you. They're asking what time you're going to be here. I said, well, I'm flattered. Let's see what's going to happen. So I told them, let's cut through the protocols and just talk about the do's and don'ts. When I introduce myself, I do what I did earlier. With all transparency, I tell people what I invest in. Today I didn't say what I do not invest in because Paul was giving me signals to stop. But normally I would, because to make life easier for the managers, for the potential partners. Transparency is very important, especially that we all know the importance of building a relationship. A relationship has to be built on honesty and on being forthcoming and being clear with what you do and you do not do. So take for example, I do not invest, I say I am from Dubai. So when I say I don't invest in pork, I expect someone to know why. But this is New York. If you are in New York and you don't know why some people do not eat pork, then I don't know how long you've been living in New York. You see what I mean? So we don't invest in tobacco. We definitely don't invest in cannabis. And we don't invest in liquor. I'm not going to invest in the casinos. Why? Because it is a legacy family and it just will be counterproductive. Let's put it this way. Not every family has to do that, but like we said earlier, every family has a vision, a legacy, and purpose. So that's on that side. Then when a fund manager come to me and say, look, I have an investment for you, Camille, that will make you rich. I just pause and I say, how rich? What for? I say, I'm not here to get rich. I'm here for, I just said, capital preservation and growth. Because this is money that we are preparing for the future generations. Now, do we turn down profit? No. Do we look for a hurdle of 8%? No. But at the same time, that's the wrong approach. Second approach is to start talking about cap rate, internal rate of return, return on cost, loan to value. I say, you know what, we are not here in a freshman year of business school or in high school. Let's just talk about something that has more depth into the conversation. But I said to them, I said, I'd like to leave you with a good advice. When you meet with the family office, if I meet with Sherry, I know that she is fully invested. She keeps some cash on the side. You go like this or like this, Sherry. So I know that you're with me.
I'm sitting in cash overnight, but I'm trading it every day.
You see? So don't expect that Sherry is sitting on $10, $20, $30 million waiting for you to knock on the door. I say, come and introduce yourself. It's best if you are introduced via introduction. I met Professor Johnson through Paul. So due to the relationship they have, it was easier fit for Paul Johnson and Camille Hamzi to open up for each other. It's all about, the introduction is valuable. Always use it. Second, when someone say I am a family office, make an assumption that they are fully invested. Best question, make it short and say, well, Ms. Ritter, if you have any exit in the near future, I would love that you would consider investing with us. Why? Because when she has an exit,
so nicely.
I
love the delivery.
You guys
You asked very nicely.
So the exit is what really, that make the assumption that she would have liquid. And with liquid, she does, you're not gonna, don't come to me and say, like just connect with me on LinkedIn and then immediately after my team accept you, I get 4 or 5 PDFs on LinkedIn. You already don't have my email. And then we're looking for a $50 million and we closing the end of October. You guys get people normally meet, flirt, flowers, dance, things, engage, and then break up. Some of them break up. So the mechanics are the same. Family office are people. There is a big family office in London. You all know them. The grandmother was alive until a couple of weeks ago, and the grandson said, you know what, I don't want to be a prince. I don't want to be rich. You all know him, you know his wife. You know, some people said, oh, Megan took him to America. No, no, the man also, I mean, look, this is a fighter pilot that flew helicopters for the English forces in Afghanistan. He's not a baby. He said, I don't want to be rich. We have that. Many families, generational families, have the same. You know, the Hennessy family, that I think they made cognac, right, Jerry? What did they make? Cognac, right? I met them at the Bluebird, and the man is 7th generation. In his own company, we were chatting in French, and he said to me, I am tired of this. My kids do not like it. They like to be free. So what I'm trying to say is that family offices are people just like all of us. You know, there is nothing mysterious about them. You pinch them, they bleed the same, they say ouch the same. Does that answer your question, Paul?
It's perfect, thank you.
Thank you.
And my next question is really for both Sherry and Sahil. One of the questions I'm sure a lot of managers have in the room today is, where are we given right now in this given economy? What are your thoughts on crypto, Sherry, and Sahil, what are your thoughts on Everest?
So crypto, I'm still a long-term believer. I feel like the technology, really, instead of looking at it as a currency or a token, you have to look at it as a technology. And there's technology being implemented on the banking side. For everyday use, you've got real estate going into crypto. There's all these businesses that are using crypto technology. I feel like we're at the very, very beginning of crypto, and the asset class has been bombed out tremendously this year. And I think that this is a good time to deploy, but deploy selectively. And also you have to have a longer term view. So I wouldn't get into crypto now thinking you're gonna get out in a month and make a profit. It's just too volatile to predict. However, I'm trading around the volatility of Bitcoin and around the volatility of crypto. And that's much more on the algo and the engineering side. So with the technology, you can see where the trade's gonna be in the next hour or two. You put on the trade and then you take it off. However, for my venture, I love crypto. I love the community. I love the IQ. I love the ethos. I feel like the crypto community is very much a reflection of my ethos and how I run my boys, my family, and our family office. And then there's crypto's not just the technology on that side, there's the metaverse. So my oldest one who graduated from my alma mater last year, he graduated from Penn, he's the first quantum and photonics engineer to graduate, which means he has an EECSE and the minors in math and physics. He's the COO of a company called Orbit, OORBIT, and they do the software and cloud backbone for metaverse, and it's really neat. So next year, you guys are going to see LG TVs come out with metaverse capability, and that'll be because of Mike Corby and his engineering team at Orbit. And so for the world's future, for America's future, I love crypto, but I feel like you gotta be truthful with yourself about your time horizon, what type of IRRs you're looking for, and the spirit with which you're investing in crypto.
Wonderful, thank you, Sahil.
Sure. So, maybe it's worthwhile to sort of describe how we think about the world and how we approach investing in equities. It's an overused term, but I genuinely believe we embody this. We take a private equity approach to public markets. In other words, when we underwrite businesses, not stocks. And anytime we're underwriting something, if we're not willing to own something for 5 or more years, it's thrown into the bin. And we've been doing this for the better part of a decade now. And so what we've endeavored to do is underwrite businesses, understand them inside and out. We'll spend 3 to 6 months really digging deep in every single business, and then look at, is this a business worth owning at the price that it's trading at today? And probably 6 out of 10 times we put it on the shelf. It's too expensive. We're not comfortable with certain short-term risks, whatever the case may be. But we continue to sort of do our maintenance diligence on it. And what that affords us is the opportunity when you have a COVID downturn like we had about 2.5 years ago, when you have inflation creeping into the market like we've had over the last 6 months, an opportunity to start to lean into our sort of research database and start to build portfolios. So we think that the opportunity set is really attractive. We look at our forward-looking IRRs in real time, and they've never been higher. But we're also not backing the truck up. We're cautiously optimistic. We're slowly building, brick by brick, our portfolio, and beating dry powder for, what may come.
Perfect. And I'm gonna get to Brian, but before I do so, if the crowd has any questions, please feel free to raise your hand and ask. We'll get to you in just a second. Brian, I just want to ask you, what are your thoughts on real estate as an asset class today, considering inflation is rising?
That's a loaded question. One of the biggest mistakes I'll start out making is that, and I see a lot of family offices making this mistake too. Just throwing a blanket on just saying, well, all real estate is bad right now, or all retail is bad, or all office is bad. And I really believe, at the end of the day, it comes down to a situational by situational, basis. There's a couple things right now that, like I'm looking at that, some people would say, oh, this is terrible asset class, but, because of the location, specific needs, specific data they have, this is actually a really solid asset and really good people behind it. So I believe that that's probably my first thought is just don't put a blanket on anything just because it has the word office or certain or certain like city or whatever behind it. At the end of the day, I do believe that there is going to be a little bit more value now, and we're starting to see, some of the valuations finally, correcting themselves, and certainly, like multifamily value add. I would say the last, 3 or 4 years, been very little margin of error. A lot of people have, ridden those coattails of, this unsustainable rent growth. Ultimately, in terms of development, one of the areas, we're very careful with, budgeting and so forth. We actually built a model several years ago for our current development activities that was designed for a rising rate environment. And at the same time, as we're looking at, land opportunities, all of a sudden we're starting to see now, things that we were looking at, a few months ago that we're just too busy to respond to. Suddenly some of those prices are coming down now to where, they're even a better value. So, it's, certainly you have to be very cautious, but at the end of the day, I think over the next several months, we are gonna see some reasonable value, for opportunities out there. I don't believe the bottom is gonna fall out, like, some people, are looking at, 15 years ago when you're buying stuff like, 30, 40 cents on the dollar. I don't know if that's gonna happen. I know, even a few years ago, people were raising all these distress funds, whether it was for public equities, real estate, private equities, saying, hey, we're at the, well past where we should be in this cycle. There's gonna be major downturns. I don't believe, it's gonna be that deep. I just think, certainly we were due for a correction or well overdue for some corrections, but biggest difference today is there's a whole heck of a lot more cash or liquidity in the marketplace than there was, 15 years ago. And I think the fundamentals, are strong enough that, after this, whether it's 12, 18, maybe 24-month transition that we're in right now between cycles, I believe there'll be a lot of good opportunities, moving forward as well.
Perfect, thank you. Adam, I think you had your hand up.
Yeah, Brian, you mentioned the family office community, and then Ms. Witter talked about the ability to be nimble and have handcuffs. And I was curious, is there anything in this world, sort of like what Allen and Company does every year, where it brings you together for networking and maybe joining forces and bypassing, no offense to the hedge funds out there, but bypassing them so you can go it alone?
Oh, absolutely. I know as I get a little bit older, I tighten up the circles a little bit more. I actually have something that I have a top 60 bench of folks that I communicate with, let's say on a monthly basis. But also, over the years, certainly there's these, big marketed events and so forth like that. A lot of them aren't worth, honestly, a grain of salt anymore as they get overly commercialized. So I think a lot of times, we look at, some of these smaller groups, like there's, for the last several years, there's groups of like, sometimes it's 5, 6, 7 folks, sometimes it's 12 to 15 of us, that are, either family members or we run a family office that, whether it's bi-monthly or quarterly, get together and trade notes and intel and along those lines. So, I think certainly keeping those circles very, very tight and trusted folks brings you a lot more quality and cuts down on due diligence a little bit. Certainly, you still have to do your due diligence yet, but ultimately, I'll tell you the truth. I mean, there's people that we've known as personal friends for 30 years, going as far back, and you do some business with them, and you start maybe seeing what they're really like in business, and also at the same time, some folks that you've been friends with a long time, they might be going through a really difficult life challenge, which changes the way that they're doing business now. So you still have to be very, very cautious yet, but certainly, I like to, tighten up the circles, but at the same time, also try to selectively, stay very networked, and be feet on the ground. It's one of the things I always say within our internal organization is the moniker shovel dirt, and that means I like to still play in the dirt and function on the dirt. Okay, hopefully that helps.
Sir?
I have a question for Sherry. When you talk about crypto, is that all inclusive of blockchain as well, or you
Yeah,
just focused on the currency?
It includes blockchain, and it's all different sides, so any type of timeline can be more on the venture side or more on the trading side. When I say crypto, it covers the whole universe.
The whole ecosystem.
Henry?
Thank you, Paul. Thank you for the terrific sharing those so far. So this is for everyone. As you are running your family offices, advising it, and also talking to other family offices, obviously investment returns are always important. But other than that, what are the maybe like the common themes that are important to all family offices? By way of an example, right? So if you look at China over the last 40 years, some of the entrepreneurs have generated significant wealth. So from the sort of the founder, the patriarch for want to maintain this family thing, succession planning or the passing the baton is very important. What are you seeing in your circle? Maybe like the top few things, they're very common in the family office group. Thank you.
So I think, Camille, you covered a lot, and I think Camille's spot on when he says that no two family offices are alike. So you're asking good questions, but they're big macro questions, and I don't think any one of us can answer for everyone else, right? So there are some, there's some families that are more capital preservation. We're in growth mode. Other people are looking to expand, but so the mandate's different. And for succession, I think it's also different for every family office. A lot of people assume, I think anyone who knows me in this audience and on this panel knows I am so in love with my children, so in love with my sons, the boys in my family, my husband. But I have zero desire for them to follow my footsteps exactly. First of all, the times have changed, the technology has changed, the generations are different. They're straddling 4 generations. They're like, for us, I will butt heads with my son because my son loves venture, and I like to be liquid every day. So there's all these different things that other families may not do. I'm really good friends, with one of my best girlfriends. Her father's a billionaire. I won't mention the company, but they have totally different investment life decisions and different perspectives. And so those are really good questions, but I really do think you'll get a different answer depending on who you talk to. And for succession planning, I think you also have to see what the personalities are. Like you said, sometimes someone's working, someone doesn't want to work, someone wants to contribute. So you have to take it on a case-by-case basis, similar to the question you got earlier, Brian. Like in real estate, you can't say all of real estate is bad. You can't say all of crypto is bad or all of equities. Like it's a very sector-specific, investment-specific situation.
Perfect. Let's give one to Fordham. Michelle right here.
Hi, Tushar, I'm first year student at Fordham University. Any questions? Just I work as an equity research analyst earlier, so equity is of any interest to me. So I was curious about your investment philosophy. When you touched on to a deep dive about a company, but what are your kind of initial filters, and then decide which companies you kind of do that deep dive in? And when you're doing that deep dive, what sort of things are very important to you? What are the things that you start with? a little bit about your investment philosophy.
Paul, can you repeat the question, please? Sure, so how do you guys analyze it? How do you guys analyze a deal or a company? What process do you take? Is that it?
Yeah, and kind of your investment philosophy adoption model and your initial filters to kind of narrow your stocks down.
Public or private?
Mostly for public entities.
Public, so that means that you.
Yeah, I mean, I'll draw an analogy to real estate because I mean, it demonstrates, you know, what do they say, like, the most important thing about real estate is location, 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 right? You wanna own high quality assets that are always going to be in demand. That's kind of the way that we look at public equities. We don't look at what's cheap or what's hot right now, what's growing, and growth matters, but when we're looking with a 5 to 10 year time horizon, you gotta focus on quality. And so that's really where we start the conversation. You look, you know, each industry, who are the businesses that are leading, have the highest returns on capital, have sustained growth for a really long period of time, not just growing really fast in a year or two. And then you do a deep dive, and the deeper you go, the more no's you end up, or more companies you end up filtering out. And then once you have a portfolio, we have this bench of a few dozen businesses, the bar becomes so high because you very easily tell yourself, listen, like, the business I'm looking at right now, it's all close to the business I already have in my portfolio. So you know, we don't pretend to be the smartest people. We really try to dumb it down for ourselves, simplify things, and really figure out how do we create a decision-making process that anyone can execute within our organization.
Perfect, we'll take a couple more, Robert.
Can I ask?
Okay, so sure, you go ahead then.
Okay. So actually, I have a question regarding family office establishment. What should be my net worth to establish my family office? Because the market practice and the market rule is $100 million. It should be either your net worth or your AUM. So, like from your perspective, what should be to establish your family office and to keep your liquid and to keep your portfolio construction well and to do succession like family constitution, etc., etc. What should be a net worth to establish a family office?
You know,
Robert, right?
Richard.
Richard, with $100 million, you're not going anywhere. Don't worry, kid.
Wow, that's a little harsh.
Years ago, the cost of running a family office ranged from 80 basis points to 1 point. So if you had $100 million, your single family office between the CFO, maybe working with an outside
It's a
accountant.
different question. I'm sorry, Camille. So what should be your net worth
Yeah.
to establish and to call yourself as a family
That's what I'm
office?
explaining to you,
Because
Richard.
like I know the cost of like how to manage VC,
No,
private
but that
equity, and family
changed.
office. But like what should be your net worth to call yourself as a family office? What should be my net worth? Like is 10 million or 100 million? Because as I said, the market practice is $100 million AUM on net worth. Like to call myself as a family office, as a single family office. From your perspective
You can have
and
$30
from your
million
practice.
and call yourself a single family office.
So there is no minimum.
No.
So I can have like $100 and I can call myself as a family office, as a single family office, right?
Yeah, but the AUM will determine the size of the team and then eventually the size of the portfolio. Is there any regulation that monitors and regulates?
Who
what
regulates
Richard
it?
will
There is no
say?
regulation.
Well, in Europe it's different. Here in America, I'm talking about. Here in America, so far, we don't have a body. But that body is coming down the road, because now we have the B corporation coming in, that will incorporate that. And then we also have the new regulation on monitoring the ESG investing, which most family offices involve. All of it is coming together, just like the Europeans. Because in Europe, to call yourself a family office, you have to declare the size of your portfolio and your references.
that was a great question, Richard. And you, sir? This is going to be the last question.
Richard,
Yes.
I'm not convinced, we'll talk later. Go on.
Okay.
Thank you. This is an open question. Anyone could answer it. I'm interested to know if you have any thresholds that you apply when you're looking at companies to invest in. Do you look for at least a 51% position or less than that? Or what are the thresholds that you might apply in looking at any kind of an investment?
For me, it's a case by case. Case by case. It is case by case. Sometimes you look at EBITDA, Sometimes you look at who is the management team, or what is a market share, or you know, what is the technology that they have, what the IPs that they have. So when you assess a company, you look for the points of strength, and then you build your pricing on the weak points. And that's where you make your solicited or unsolicited offer. And that's what I say, my colleagues can have their own, right?
I know the few times that, you know, we've done a, you know, operating company, and then also two of the board positions I'm on as well. I mean, for the vast majority, you're taking a control position. You know, whether it's just on paper, but typically from a macro perspective, you're taking a control position. Occasionally, you're taking a, let's just say, you know, at the very least, a significant minority position. But for the most part, you want to have a controlling interest in terms of the macro level operations, or I should say the macro level direction, and then more importantly as well, just a hand in the strategic value that you're bringing to the table and strategic direction. Because most of the time, you know, if you're going direct as a family office, you have the, you know, the resources and the domain expertise into what you're investing into. For the most part, there are some exceptions to the rule, but typically, if you're going to go direct, you're taking that control position. In addition to the capital, you are bringing your domain expertise, your Rolodex, and other resources.
Can I ask a follow-up question? Since you're not applying a numerical criteria, are you looking at companies where you can, because of operational or other expertise, that you can add value to the company? How are you adding value? What is your criteria for adding value? Your own, or the company you're investing in?
We all entrepreneurs, Arthur, and you will come in if you have a vision that this company might fit into your portfolio. So you're doing either horizontal, you know, acquisition, or you're doing vertical acquisition, as we know in the private equity. So again, all those factors that I mentioned before, they play a major part in my decision making. You know, if I am missing an IP and they own, so really I'm looking for the IP, and I will leave in the contractually a transitional period where we eliminate redundancy. Because, you know, when you acquire another company, you always have redundancy. So you start doing the process of elimination. You know? But the initial pricing is always based on the highlighted values and also on the downside. And that's what you take with you as cards when you sit down at the negotiating table. Did that answer your question?
Yes,
Perfect. Thank you very much, guys. Let's give a round of applause.
as always.